You heard it there, Lizanne, more than 50% of a recession, potential stagflation. We have Neil Dudda calling yesterday not Liberation Day, but Obliteration Day. Is it as serious as it seems at first glance?
Oh, I think the math is such that, yes, at this point, we don't know ultimately whether some of these tariffs will be lessened, but it's pretty easy to feed this kind of hit to the economy into models that suggest recession risk is quite elevated. And by the way, even before yesterday's announcement, you were seeing an increase in probabilities associated with recession because we have seen the key component of U.S. economy, 68% being consumer spending. Consumer spending, based on the tracking of data we have already in for the first quarter, was tracking in negative territory. And that's why metrics like the Atlanta Fed GDP now, even adjusting for the non-monetary gold imports and exports, are down in negative territory. I don't think what happened yesterday makes any of those stories better.
Lizanne, how much inflation could we end up importing if these tariffs don't get dramatically reduced and in the very near term?
Well, so there's where the debate, I guess, has been interesting, which is what do tariffs represent in terms of the inflation outlook? And the tariff proponents suggest it's not an ongoing increase in the rate of inflation, and that's how inflation is expressed and reported, but a one-time level step up in prices. I'm not sure we can say the latter with any confidence at this point because there are so many layers to these tariffs. We're still dealing with different deadlines, the prospects for additional tariffs to come from a sectoral perspective. So the culmination and combination of all of that suggests that the upward pressure on inflation would not just be a step up in the level, but the potential risk of an ongoing increase in terms of the rate of change. And this stagflationary backdrop puts the Fed in a bit of a pickle. Estimates soared between yesterday and today for probabilities of a cut at the May meeting, a cut at the June meeting. But if you've got inflation moving in the wrong direction, that means the dual mandates of the Fed are sort of sending polar opposite messages. And it does make it much trickier for the Fed's reaction function.
Is there a world in which the Fed needs to consider some kind of an emergency action, Lizanne, or can any reaction wait until we see plenty more data? Bear in mind, we get a jobs report Friday, but it's not going to tell us much yet.
Well, I don't know what emergency action would do if we're talking about the traditional levers that they pull with regard to the Fed funds rate or the balance sheet. If this were a problem that was infiltrating the global financial system, and we're really talking about a seizing up in the financial system in credit, then yes, there are tools they can use. We saw that as recently as 2 years ago when we had the mini banking crisis. They also did that in the face of the worst part of the pandemic, where they wanted to prevent what started as a health crisis and becoming an economic crisis from becoming a financial system crisis. So they, pulled back the lever and went back to zero or ZIRP policy, zero interest rate policy. We're not talking, at least at this point, of a seizing up in the financial system. So I'm not sure anything aggressive, either via the balance sheet or the Fed funds rate, would go at the heart of this particular problem for the economy.
But the risks are becoming elevated all over the place, right, Lizanne? So even things like inflation expectations, which is something the Fed has been very concerned about, but hasn't had to do anything about just yet.
Well, that's the point. They're dealing with their inflation side of their mandate moving against easing policy here, and increasingly the growth side or the employment side of their mandate moving in favor of easy policy. So hence the pickle that the Fed, I think, finds itself in. And that's the nature of a stagflationary backdrop when you have a central bank that operates with a dual mandate and you have mirror image outlooks for both components of that dual mandate.
Lizanne, we've been around for a few of these crises, right? Nothing quite like this, but they're never the same. March 16th, 2020, we saw the NASDAQ drop more than 12% in one day alone. Now, we're down 15% from our peak in February, but should we all cool down just a little bit?
Well, I don't know about that. I'm trying to suggest what a bottom is, a short-term bottom, how big a single-day decline an index might have. That's a fool's errand. There are people that attempt to do that and then pat themselves on the back if they happen to be right. I just don't think that that's investing. That's just gambling on moments in time. But I think part of the reason why the tech and tech adjacent space is getting crushed, and I know there have been some on the airwaves suggesting this is just about DeepSeek, but it's more than that because it really gets to the heart of the unbelievably intricate global sort of ecosystem there is in terms of trade. And when you think about the tech and tech adjacent companies and how much of their inputs come from overseas sources, and even in the case of tech, when a lot of those input sources were adjusted to be, instead of maybe from China to Vietnam in response to the 2018 trade war, you've now got a target on Vietnam's back and tariffs on goods imported from Vietnam at 46%. So this is having a direct impact on the tech space, and it goes beyond, the weakness goes beyond just the DeepSeek news, which is now 2.5 months ago.